In this lesson, I'd like to talk about risk versus reward. Now, anytime you place a trade, you want the potential profit to be at least 2 times what you're risking, preferably 3 times or more what you're risking in order to be worth doing the trade. Because remember, we're only going to be right about half the time or even less than half the time. So you want your potential profit to be big enough to be worth doing the trade. And that means potential profit should be at the very minimum double what you're risking. Now, because your initial daily maximum loss is going to be $40, you should plan on placing trades where you're risking about $5 to $10 per trade, okay, based on what the charts are telling you. And your potential profit should, again, be at least double. So let's look at the charts and look at what that would look like. So here's a strong chart of CF Holdings. And the stock went up 25, 50, 75, over $1 in the beginning of trading, the first hour. Now, let's say that you started to see this stock right about here, and you don't want to buy it because you don't know how far it's going to pull back or when that's going to happen. So you just decide to wait and watch, which is the correct thing to do. So there are 3 things that I really like about buying it right about here. Number 1, the stock was very strong going up. Number 2, the pullback was tiny, relatively small compared to how high it went up. Pulled back only about 20 to 25 cents from the big run up. That's not very much. Okay. Typical area might be 50 cents or 50% of the move. So this is not very much of a move at all. And then when I see the stock go sideways, all of that is a very good sign. So let's just say that I buy at 28.08, right about in there. And I say, I'm going to risk 10 cents on this trade because if it goes down below the whole number of $28 per share, that's showing me the downtrend is still in place. This downtrend right here. Okay, so based on this chart, that's a very good entry point and a very good risk parameter. Now, the thing is, based on this chart alone, we don't know what the potential reward could be. Okay, we're risking 10 cents. We want to make at least twice that. How do you know what the potential reward is? Well, honestly, you don't. You don't know. But because the stock has already gone up over $1, there's reason enough to think you could make at the very least 20 cents on the trade. And in fact, from 28.08, it went up to 28.70. So that's more than 60 cents. So that would have been, if you had traded it just perfectly, about 6-to-1 profit versus risk. Now, honestly, the way I manage my positions is I don't want to get out on the little wiggles like that right there. 2 little, down candles, just a few cents, and then it goes back up. I don't like to get wiggled out, and gain 5 cents when I could have made 50 cents. That drives me nuts. So I'm going to let it prove to me that the uptrend is over. So I'm going to get out right about here. Around 28.50 to 55 is honestly where I probably would have finally been convinced the uptrend is over. So that means I would have made about 45 cents on the trade, and I would have risked 10 cents, or 4.5 to 1. 4.5 times reward versus risk. That is how you set up good trading. That's good trading. The entry is good. It's got high odds of success. And the reward versus the risk is at least 2-to-1. So that's a very good trade. Even if it didn't work out, you set it up the right way. Now here's another trade. This is eBay. And eBay comes out after the open, going mostly sideways, pretty choppy. But before lunch, it does shoot up about a dime. And then during lunch, we got a sideways range. basically between support of around 33.64. That's the floor. Now again, it's not an exact price, but it's within a couple cents. And then we've got the ceiling of resistance around 33.71. Okay. So do I want to buy eBay at 33.65 and risk 5 cents to make 5 cents? No, it's not worth it. It's not at least 2 to 1 profit versus potential loss or risk. So we don't want to do that trade. Considering you're only going to be right about 50% of the time, that's either a losing trade or kind of a break-even trade over time. If you did that same trade and you were, repeatedly, and you were only right half the time, then you're going to break even or lose money. It's not worth doing that trade. So how would I want to trade this? Well, honestly, I want to see it show me which direction it's going to break out of. And so I probably would have sold it short right about there. Call it 33.62. And then maybe I would have got out right there, around 33.52. And maybe I would have made a dime on the trade. eBay's not a huge mover, but as long as it didn't go against me more than 3 or 4 cents, I would have been fine. I would have stayed in and made a little money. So I would have done it that way because it's showing me which direction it's going to go after being in a sideways range. Now, if eBay had been in support at 33.65 and resistance at 33.80, so it's a big range, that's tradable to risk a nickel to make 15 cents just for a target at the top of the range. But we don't have that. It's a tight little range, so that makes it not worth buying at support here just to hit resistance. Okay, there's one other chart let's look at, and this is Apple. Now keep in mind, Apple trades at around $146 a share. So it's going to be really volatile. So unless your entry point is about perfect, the risk parameters are going to be too big for you. But let's see how we could have traded this, even with these risk parameters. So Apple comes down and then shoots up at the open on May 3rd. And it goes up more than $50, about $2 per share. And then it pulls back about 75 cents per share. Now, if you look real closely at these candles right here, you've got 1, 2, 3, 4, 5 candles in a tight little range. Now, I actually zoomed in on those candles on the stock chart, and I saw that that's only a 20-cent range, which is tiny for a stock like Apple. So what you could have done is bought the stock right around 145.75, let's say. Right around in there somewhere. Now, normally I want to see it shoot up before I buy it. But in this case, I might have just bought it because it's up so strong and then a small pullback and then sideways in a tight range. And it's not dipping below those tails. So I can risk just a tiny bit on the hopes that it'll go up. So again, is there enough potential reward to risk 10 cents on this trade? Absolutely. For a stock that just went up $2? Yeah. Okay. And in fact, that's exactly what happened. After that point, which is about 145.75, the stock went up to 147.50 at a maximum. So that's about $1.75 there. That's great. That's more than enough reward for the risk. And so what is that? Several times reward versus risk. So that's would have been a great trade to do that, even within your risk parameters. So just keep in mind your potential reward should at the very least be 2 to 1, if not more. Go ahead and take the quiz now. And when you're ready, move on to the next video.